What's up, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts, and Wall Street watchers and AI degenerates, it's your favorite time of the quarter. The great capitalist conference known as earnings season, where companies either pop champagne or pretend that losing $500 million is, well, just a part of the plan, right? Let's go ahead and dive in. We got 7 companies, 7 different vibes, and only one roast. Let's get into it. First things first, AppLovin, the ad godfather. AppLovin just posted God tier gains. Revenue jumped 77% year over year to $1.26 billion. Net income $820 million. That's up 164%. Their adjusted EBITDA is over $1 billion this quarter. How? Simple. They stopped running apps and focused on their ad tech platform, and oh boy is it working. They even sold their old app business for over $400 million cash and equity in Triple Dot Studios, which sounds like a Mario Kart level, but is in fact a real company. Their Q3 guide is $1.34 billion in revenue, $1.09 billion in EBITDA. That's an 81% margin. Takeaway: AppLovin is the rare ad tech company making actual money. They're minting cash like it's 2021 again, and they're actually bringing profits with them this time around. The next company we're going to talk about is IonQ. Is this quantum or just theoretical at this point? IonQ's revenue soared 81% to $20.7 million. That sounds awesome, right? Well, they also lost 70 cents a share, and their EBITDA margin is a negative 176%. Yes, you could lose money faster by throwing it into a wood chipper or even setting it on fire. That might take longer. But they raised full year revenue guidance to $91 million. So they're bullish, or as quantum physicists say, simultaneously bankrupt and thriving. The takeaway: they're still burning cash, but Wall Street doesn't care because quantum. You say the word and analysts start drooling like it's Pavlovian. Now, the next thing we're going to talk about is Duolingo. And no, they are not in the headlines for their mascot going around bullying people on social media to get into learning a new language. They just dropped a flex so hard it made retail traders fluent in gains. Revenue beat, EPS beat, user growth blew expectations out of the water, and the stock popped 34% in one day. And we're currently up 26% in our session right now. Retail chatter surged 1,400%. Basically, everyone and their abuela is now bullish. The AI strategy is working, monetization is strong, and their brand is somehow making education cool. The takeaway here is the green owl went from cute to, well, killer. Seriously, this company just turned learning French into a momentum trade. Next thing we're going to talk about is everybody's favorite pastime and what leads to probably most of your divorces: gambling. DraftKings is on deck. It's betting on itself too. DraftKings pulled off a classic Vegas move, missed EPS, but still walked away richer. Revenue, $1.51 billion, up 37% year over year. They beat expectations. Their adjusted EBITDA crushed estimates. Their monthly unique payers are up. They reaffirmed full-year revenue at $6.3 billion and hiked EBITDA guidance to $850 million. Takeaway: profitability is coming slowly, like a drunk bettor at 3 a.m., but it's coming. And unlike most gamblers, DraftKings actually wins money. Now, let's jump back in to our quantum mindset, because we're about to talk about QBTS, aka D-Wave, quantum with an AI hangover, or quantum with a hangover in this case. D-Wave Quantum reports $1.7 million in revenue, up 51%. Good, but a loss of $18.6 million, not as great. The stock dropped over 20% off that news alone. However, we're seeing a little bit of a recovery here with only a 4.4% loss so far, but it is still coming off of that high of about $18 a share. And they're trying to pivot from researchy quantum stuff to commercial applications, like real companies. Takeaway here, there's potential, but right now they're spending millions to make thousands. It's like building a Hadron Collider to microwave a burrito. Completely pointless. I mean, you could do it, but that would be a very expensive microwaved burrito at the end of the day. And next up, we have everybody's favorite energy drink, Celsius. So, what happened with them exactly? Well, they blew the doors off. Celsius absolutely torched expectations. It is now the energy drink of the gods. Move over, Red Bull. It's cool that you have people jumping out of planes and putting their life on the line, but these dudes just endorsed a couple NFL players and some NBA players, and look at where they're at now. EPS came in at 33 cents versus 21 cents expected. Revenue came in at 740 million versus 655 million expected, and the stock saw a 21% pop. It's currently up 19% in regular hours. Now, why did this happen? Strong growth across its energy drink brands, especially Alani Nu, which sounds like an influencer, but is apparently liquid rocket fuel for retail. They now own 17.3% of the U.S. energy drink market. That's absolutely insane, by the way. Takeaway, move over Red Bull. Celsius has wings, abs, and better margins in this case. And to round out our 7-on-7 for the day, let's talk about everybody's chubby lover company. Chub lovers, gather around. Eli Lilly crushed Q2. Earnings beat, revenue beat, raised full year guidance. They even sold $3.38 billion worth of Zepbound and nearly $5.2 billion of Mounjaro. So why did this stock drop 14% exactly? Because their new daily obesity pill didn't hit expectations. It only helped patients lose 11.5% of body weight, slightly worse than the rival Novo Nordisk's shot. Wall Street basically said if I wanted disappointing weight loss, I'd just try keto again, or I'd go gluten-free, or I would be a vegetarian. Takeaway, great quarter, bad trial, massive overreaction, but now the door is open for smaller biotech challengers. So, who crushed it this earnings cycle? Our winners, App, profitable growth god. Celsius, crushing it in coolers and on charts. Duolingo, AI plus education equals a moonshot, and DraftKings still hitting the spread. Losers, Eli Lilly, one pill miss equals 60 billion market cap drop. QBTS, great science, but brutal math. And IonQ, quantum dreams, quantum bleeding. It's a wild market. AI is hot, ads are hot, drinks are hot, and biotech is having a hot mess moment. If you made it this far, you're a real one. Now hit that like button, slap subscribe, and comment below. Which stock are you buying on the dip? Which one's still too early? And remember, it's not about who makes the most money. It's about who can convince Wall Street, hey, they might someday.